I think investing is a very simple business, and it actually doesn't need too much of innovation. In terms of our investment approach, the more old-fashioned it is, the more appropriate it is for achieving long-term results. And the best investors are the ones who don't, give up the grounding of right investment principles. We would want to continue that. I think where innovation plays a very important role is how do we increase our access to customers, or how do we simplify access, how do we reach more people, how do we educate more people, and do this in a more cost efficient way, in a more scalable way, thanks to technology, thanks to payment infrastructure that is built in the country today. We can reach the smallest of town. I don't need to open a branch. Every customer who has a mobile, effectively that is my branch.
What do we look for when we are making an investment? The right expertise, the right framework, the right process, and most importantly, the right intent. A warm and enthusiastic welcome. In this recent episode of our Dialogue with the Veteran series, we have had the privilege of interviewing the man behind DSP's 1.7 lakh crore portfolio. His name is synonymous with success in the finance world. With over 34 lakh Indians putting their trust in him, there is no denying the weight of responsibility and expertise that he holds. Ladies and gentlemen, with great delight, I would like to welcome the Managing Director and Chief Executive Officer of DSP Mutual Fund, Mr. Kalpen Parekh. In this captivating conversation, he shares with us the secret recipe of DSP's success. A family-owned business with 160 years of history, built with ethics and integrity, and also learn the intricacies of investing and valuable money lessons from the experience. Without any further delay, let us embark on this captivating conversation with the industry veteran, Mr. Kalpen Parekh.
Yeah, hello, good evening, Kalpen. Thank you so much for accepting this discussion call. Excited to be here. Welcome to this discussion session.
Thank you.
So let me start with the very first thing that I want to ask you. An interesting question on that. You're working with DSP AMC. It's a family-owned business, but which believes in professional management. This is something really, really unique, right? Among AMCs, or really with any business at all. What do you think are the benefits of this kind of a structure where the ownership is different and the management is different?
So this is a business of compounding. We tell our investors that come and invest with us for decades. You tell your investors that real wealth creation happens only over decades, not in 1, 2, or 3 years. So this business needs time to achieve the collective outcomes of your investors, you as our partners, and we as a fund house. And the dimension of time needs, long-term decision making. The beauty of a family-owned business, especially if the family is truly long-term in its thinking, it lends a lot of longevity and patience to decision making. It allows us to think really very long-term, and it allows us to align the interests of the investor, the shareholder, and the operating team together. So one very important advantage, in fact, globally, if you look at asset management companies, there are two types or two models. One is large professional setups alone, or there are boutiques who think from a 30, 50, 60, 100-year thought process. When I joined DSP, I joined DSP BlackRock. The attraction for me was I'm joining a partnership which has the largest fund on earth as one of our partners. But the more important attraction was I also have India's oldest financial services company.
Yeah.
So I was surprised to know that time that DSP had a 155-year history, and the group is now, as of today, in 162 years old. It's crossed 16 decades of existence, and I think that is the thought about longevity. So what happens is that if something has lasted so long, it means it has made less mistakes. It has conducted itself with a lot of prudence, and it has conducted itself with a lot of responsible way of doing things, which is the most important ingredient when you are managing other people's money. And I think that, really makes all of us who work here at DSP, like what we do, because we know that our decision making can be long term, and we all of us always believe that it is in the long term that wealth is made. So I think that is the advantage when you are a business owned by a family with the right spirit, the right principles, and the right intent, and operated by a professional management, which ensures that the best of excellence comes on the platform.
Yeah, I think one of the very good points as far as a family-owned business, which is really thinking very long term, is that the quarter-on-quarter pressure, which normally, I mean, CEOs like you will face, I think that is not going to be there at all, and you can really think from the long-term point of view, next 5 years, next 10 years, that kind of a thing, right?
So I'll give you an example. I just joined in 2017,
Yeah.
and the next day, and our head of equity came to me and said that our most popular fund has been DSP Micro Cap Fund, which now is DSP Small Cap Fund. And it was at a point in time where the last 5-year returns were some 40% CAGR. So some crazy numbers, right? And these were those heady days between 2013 to 17 when there was a huge upcycle. And 65% of our inflows were coming in the small cap fund. And the fund manager, out of prudence, said that I now am not very comfortable buying more and more at these valuations, because I think these valuations are becoming irrational and we don't want to deploy a lot of money. So I said, what is your suggestion? So he said that, I think we should stop taking inflows. So I said, okay, so do it. What is stopping you? So his point was that, you are just joining, it's one day in the company and 65% of our volumes are coming. So you may want to, sound it out to the board or to the management, to the shareholders. Next day was the board meeting. We put across this point of view, and this decision took just a minute to take.
Oh, okay.
These are the virtues of long-term thinking and taking the right decision. So this gives us confidence that whatever is right to do, we can openly debate, discuss, and choose the right path. Sometimes we go right, sometimes we go wrong. But broadly, that good intent can actually be executed.
Correct. Very good. Very, very correct. So there are two interesting things that I had found about DSP. One is you have a invest for good philosophy and you have a framework based thinking. I mean, both these things were very, very interesting. I want to know from you regarding these two aspects, please.
So, I spoke about the longevity or the length of the history of the group, which is 160 years old. So in a way, it has a lot of good length behind it. And the group is also known to do, a lot of things beyond just the investing business in terms of its other initiatives on wildlife conservation, a lot of other trusts. So the concept of doing good is a part of the family in a way, in various ways, silently or otherwise, they keep doing a lot of work. We have a separate company called the Wildlife Conservation Trust, which after the government of India does the largest amount of conservation efforts across, multiple forests across the length and breadth of the country. So the thought process of doing good is embedded in the roots or the ideology of the family. And our whole thought was that, what is money? End of the day, money gives us freedom. Money allows us to live the life of our choice. Money also allows us to do good for others. So when we coined the word invest for good, the line invest for good, it had two important valuable meanings that we wanted to stand for. One, real wealth is made when you invest for good, which is good length, good time horizon. So we wanted to convey that dimension. And second, if we end up making meaningful wealth, if we enrich ourselves, through money, we can use that money also to do good and to be good. So, that is the way we really thought about. So for us, it's not just, one tagline or a marketing line. We were very clear about it that we have to be authentic in whatever we say. If we don't have anything to say, it's okay not to say at times. But if we say something, let's try to be authentic. So that was the first point. The second concept about, investing with frameworks, I would say that, almost every fund manager today in the country would have some framework or the other, would have some rule book or the other. Sometimes it is stated, sometimes it is not stated. I remember again in that period of 2017 when one old couple from Chicago came to meet us. So they both collectively were running their own family office, and that ran into some hundreds of millions of dollars. So because it was old family money, multi-generational family money, and they've been investing around the world for the last 60, 70 years. So in their search for good money managers around the world, they had come to India and they were meeting us as well. And in our meeting, as usual, we presented saying that, we have great investment processes and so on and so forth. So the lady asked that, okay, write down the 10 steps of your process. And, me along with my colleagues said that, we have morning calls, we have weekly meetings, every Wednesday we have a no noise day. And after that, she was smiling and then she made a comment that, this is not process, this is the list of activity you've given. I want to know, how do you think? I want to know what type of companies do you like and why? What type of companies you eliminate and why? How do you manage your risk? How do you decide around valuation? So we gave answers to all, but she said that if it is not written according to us, it is not there. And that's how we evaluate managers. So that was our big learning, to say that, okay, while we have it in our minds, and as professionals, many times professionals have a finite life, whereas organizations have permanent life.
Correct.
So how do we capture the principles of good investing? And there aren't many principles of good investing. There are only 3-4 different styles in which you can achieve your great investment outcomes. So we all had it in our mind. We said, let's write it down. Let's create these documents. And there can be some nuances which are different if Suresh manages a fund versus Kalpen managing a fund. The nuances can be slightly different or diverse, but the core principles remain more or less consistent over all periods of time. And that is where we thought, let's write down, so that one, we are transparent about how we think about portfolio construction, about our ideology, about our style. Let's write down our mistakes. Let's write down what have we learned from these mistakes. This also will help us become more accountable. So tomorrow, for some reason, if we are even deviating from our framework, you as either an investor or a financial planner can question that you said something, but this is how your funds are being managed. So it is only the spirit of accountability, transparency, becoming better and becoming more method driven. We started writing our investment processes, our investment frameworks, our investment principles. It was not a simple thing. We thought writing down is not too much of rocket science. It will take 2-3 days to write. But as we started doing it was a journey of almost a year and a half. And now a lot of our effort is to constantly validate. So if we have written that investing in high ROE companies generally generates the best wealth, but there are enough periods of time when low ROE companies also generate superior returns. So is that the truth, or is this the truth, or are both the truth? So we have to constantly keep learning, keep embracing cycles and changes, and evolve our frameworks so that we keep becoming better and better over a period of time. Another advantage of this is that I say tomorrow if I want to hire new talent, we ask them to write their investment philosophy, their approach. And many times you realize some people either do not have it and hence cannot write it, or have it in their mind but are not articulate about it. So it also helps us in our talent search, in our talent, suitability mapping. And, let's say we have 3 different styles at DSP. This ensures that I'm able to hire the right style for the right product. And, we don't end up mixing it.
Yeah, that's very good. I mean, wonderful to have a proper framework and have it written down. And one very interesting thing that I also when I went through your website, one of the things which has been mentioned that is that asset gathering is not really your goal at all. I mean, you have been there around for 162 years, and you have shown that level of longevity. But at the same time, you are saying asset gathering is not your goal. However, I mean, you have been growing all along, and you are in the top 10, 11 in the mutual fund industry. So, what do you see as the engine of growth for a company like DSP, which has been around for, the longest among the mutual funds?
So, in spite of our longevity, can I say I'm happy with our progress in terms of the number of investors who we serve, or the number of distributors, who like to work with us? I feel that number can be a lot better than where we are right now. In all honesty, I would be lying if I say I'm satisfied with that number. That number can be more. We probably, need to do a lot more better in terms of our execution, in terms of doing things the way we do and communicating it more effectively, so that our number of investors who invest with us, that family continues to grow, or investors who invest with us for a longer tenure, that number continues to grow. Also, I don't like this concept of top 10. Top and 10 don't go hand in hand. If you're 10, you're not in the top. If you're in the top, you can't be 10. So if you are ranked 15, I would have said you are in top 15. So these are okay, part of some, these are some of the vanity metrics. But
Yeah.
what we want to do is to create a tribe of successful long-term investors. Today we have 33 lakh, 35 lakh investors. Some are long-term, some are medium-term, some are short-term. Some have come for the right reasons, some may have come for the wrong reasons because there is a frenzy in the market, and some funds do very well. Our intent is that ultimately, people are giving their hard-earned money. If we can help them learn the right principles of investing, help them become better investors, help them take better investment decisions, either via our channel partners or even those who come direct to us. Sometimes they are also misbuying. So we try to, make our efforts to the best of our ability to guide with all honesty, with all authenticity about our, opinions on investing, styles, or where should money be allocated more or less at different points in time. So we would like to be more successful in terms of some of these numbers than where we are right now. And what I meant when we said we don't want to do asset gathering at any cost would be to break the cycle of wrong investing that tends to happen. See, typically the human being is wired to be an investor who will chase fast returns. And when we chase fast returns, we give up on future returns. We actually are buying something very risky. So in that sense, timing actually matters. So we like to time our products. We like to launch funds when that style or that category or that asset class or product class is in a low cycle. It's not easy to raise a lot of money that time. You might collect smaller AUM, but if my starting NAV is low, the compounding of NAV will help my AUMs grow faster or grow longer, and will also create a better brand experience for our investors. So that is what we meant when we said we are not keen to asset gather. We are very keen to asset manage large AUMs. So when I say we don't want asset gathering, doesn't mean we are happy with small size money. As long as the style is right, the fund is right, the time horizon is right, we would want to be large and successful and add value to more number of distributors and investors.
Correct. Wonderful. So coming back to the invest for good, that philosophy, the real long-term philosophy, it's a philosophy which your partners have to understand, the distributors have to understand, and other people have to understand. And investment behavior is also something that the partners need to understand, and they need to help the investors stay that long period of time, which is fundamental to your overall philosophy. Can you tell us what you're doing towards that? I mean, communication includes communicating to the distributors and through them trickling that down to the investors. So what is that you're doing in that part?
Yeah, I think this spirit of, see, it's easy to say invest for good and invest for long term. We've all been saying right from the day we have, taken birth. Right? I don't think on any day we would have not said this one line that invest for the long term. So I think this is the truth we have to keep repeating every day. And in all our mediums, when we talk to investors, when we talk to our distributors, when we write our blogs, when we launch our funds, when we write our investment views, we talk about this longevity. When we talk about our portfolio turnovers, most of our funds have a 15 to 20% portfolio turnover, which means mostly companies on an average remain for 5 years in our portfolio, and the winning companies have been there for 8 to 10 years. So that is one first manifestation that what I'm preaching to you, I myself am actually applying it in my portfolio construction. We are not dogmatic about it, because if companies become poor or valuations become poor, we are happy to get out. So that's the first point. The second thing, like I said, is in our conduct and our behavior. When do we launch funds? When do we raise money? And when do we stop taking money? So that the long-term experience of investors is good. So in 2017, when small cap funds are giving the best returns, we stopped taking money. And on 1st April 2020, after COVID, when the same fund is down 40%, we reopen the fund. And when we reopen the fund, our first ad campaign does not say that this fund in the last 13 years has given 18% CAGR, which is in a way showcasing greed. But we actually say that this category or this fund in its worst year has fallen by 67%. So the nature of the beast is volatility. If you do not understand or appreciate it, this is not the right fund for you. So this is manifestation of highlighting risk and not only highlighting rewards, because the customer is only investing for rewards. It is important to bring that balance and highlight the other side of the coin. Or we launched our healthcare fund in 2018 after a 4-year period of negative returns for that category. When a lot of customer appetite was for global tech stocks and Nasdaq driven products, we launched a value fund when it for 20 years had underperformed as a style. So now, these are not easy decisions because you don't get tons of money. People are not waiting outside your, office to queue up and put money, but it's fine because, you're inculcating the right ideas at the right point in time. We've also created very interesting tools, digital tools for our distribution partners and investors where the journey of every product of ours. Today, we have 42 funds, 46 funds across asset classes. Each product's journey is, visually available on the website if you log in on that tool. And I would urge you to also, spend time and have a look at it. It shows you, when you make money, what are those 4-5 year periods when you made zero returns? What are those periods, when you made positive returns? What are periods when you earned less than fixed income returns? So these tools are again, designed to help you become better investors and take the right decisions. So I think these are some examples or samples that I'm, highlighting around our intent to do what is right to do for our investors' money.
Wonderful. So I mean, mutual fund industry has been growing wonderfully well, and you have also grown along with the mutual fund industry. You have also shown very good growth. I think along with India's Amrit Kal, I think it is going to be mutual funds Amrit Kal in this decade. So what are all the things, what are all the innovations that we can see from DSP going forward in the next maybe 7 years or so?
So Suresh, my view is that investing has to be very simple. It doesn't need innovation, to be honest. I'm maybe making a slightly debatable comment that the rules of investing are very old-fashioned, and generally old-fashioned investing has won in the long period, in the long run. So there are 2-3 very big mega trends. Per capita, per person in India, that wealth is only rising and will continue to rise over the next few decades. So that is going to ensure that the pie continues to expand. The concept of mutual fund is the best concept ever in the history of capital markets, not just in India. And more so in India, the regulators have created a beautiful framework, a beautiful product in terms of transparency, cost efficiency, tax efficiency, access, responsibility, governance, rules. So, again, it is a great vehicle which will safeguard investors' money because of competitive intensity as well as regulatory frameworks. So, everything that is needed for an investor to leave his anxiety behind and give money in a credible investment vehicle is in place today. So all we need to do is to, minimize errors and, not make big mistakes, not create unusual claims or not create irrational expectations in the minds of investors. And many times whenever, the narrative becomes Amrit Kal type of narratives, generally it happens when past returns are very high. Now, these narratives, disregard the concept of cycles and they teach the wrong lessons. They sometimes, create an expectation that, we'll continue to get linear returns of 15% every year or 20% every year. And that is something that we have to guard ourselves in periods like this. So I feel in investment, one has to be counter-cyclical. We should be less euphoric when returns are euphoric, and we should be more euphoric when returns are not euphoric. So I would try to cushion the exuberance at extreme up cycles and become more aggressive in down cycles. From an innovation point of view, I think what is needed is to innovate access, is to innovate transmission of good investing messages to crores of investors in a more cost-efficient manner. I think investing is a very simple business, and it actually doesn't need too much of innovation. In terms of our investment approach, the more old-fashioned it is, the more appropriate it is for achieving long-term results. And the best investors are the ones who don't give up the grounding of right investment principles. We would want to continue that. I think where innovation plays a very important role is how do we increase our access to customers, or how do we simplify access, how do we reach more people, how do we educate more people, and do this in a more cost efficient way, in a more scalable way, thanks to technology, thanks to payment infrastructure that is built in the country today. We can reach the smallest of town. I don't need to open a branch. Every customer who has a mobile, effectively that is my branch. Or every distributor, whichever town or city he is in, if we can reach him on his mobile smartly, intelligently, thoughtfully, contextually, I think we spend a lot of time thinking about how can we take advantage of sensible marketing and technology, and think digitally to communicate and to reach our investors. Some advantage of technology also comes in the way we do our investing in terms of using today's technology, computing power, and ability to synthesize a lot more data at a faster speed towards better investment decisions and towards recording of our existing investment decisions and learning from our mistakes and becoming better. So we spend a disproportionate amount of time on leveraging technology, both on improving our investment processes and on improving our access to our investors. So I think these are two areas where technology and innovation will play an important role in our journey.
Wonderful. Last question, your advice to investors. I mean, you have a philosophy, you have been around for the longest possible time. You have a framework for investing. You have everything going for you, and now you have the digital infrastructure also in place at DSP. So, what is your advice for investors going forward?
Yeah, I think I always expand DSP to give this message. It is don't stop playing. The whole idea is markets will have fluctuations. Asset classes will fluctuate. They'll go up. They'll go down. NAVs will fluctuate. Your expectations will sometimes be met, sometimes be exceeded, and sometimes you will be disappointed. Market is not here to give a finite number of return. Unpredictability is the nature of the beast. So, markets are unpredictable. On top of it, we as consumers are unpredictable. So I think the only way we can navigate this reality is by first knowing the truth. And the truth is markets fluctuate. So, if you come in blind to this truth, then you will always get disappointed at the wrong time. You will get excited at the wrong time and ultimately not even earn savings account return. So what we tell our investors is that choose the asset class right, depending on your risk profile, your needs, the time horizon of your goals, and the value of that asset class. So if you just broadly do these four things right, you will get reasonably good outcomes over a long period of time. Length is very important in this game. In the equation of compounding, time is raised to the power of. So the variable time has maximum impact. The variable R, which is return, has plus sign before it. So it has relatively less impact in the overall equation of wealth creation. As human beings, we obsess a lot more about R and a lot less about T. So I just tell investors that, first is start early, and second is last longer or stay till the end. Don't jump in and out. Embrace cycles, celebrate corrections, don't celebrate peak markets, because you have to do the opposite of that. And if you are able to do the opposite of that, if you are able to acquire more units, I think in a nutshell, we have to be collectors of units. And you can acquire units when markets stagnate, not when markets fly. So learn to embrace corrections, because 50% of times markets will disappoint. And those are the times our real moment of truth will be. That time, whether we are in Amrit Kal or not, will get tested. So I think more than Amrit Kal of the country will continue to progress with us or without us. Industry will progress with us or without us. As investors, we have to ask this question, that can we convert these opportunities into our Amrit Kal? And that will only come from good investing behavior.
Good. I mean, so the message in short, I think I'll just paraphrase what you said. Don't stop playing. And
Yes.
don't stop playing, because DSP also stands for discipline, science, and process. So they are going to manage the assets with discipline, science, and processes. So you can continue to play, and you can continue to, get wonderful returns or your Amrit Kal, whether anything happens up or down in the market. So thank you, Kalpen, for coming on this call for this discussion. I hope it will be very, very useful for all our viewers. Thank you so much.
Thanks, Suresh. Thank you for this opportunity.
Yeah.
And thank you.
Thank you.